Hello everyone and welcome to today's presentation here at TradeStation. My name is Don Prattle. I'm the Director of Trader Development and Education here at TradeStation. I want to thank you for your patience. We had a few minutes of technical delay, but we're ready to go right now. And our presentation entitled How to Trade Gaps and Breakouts with TradeStation is being presented by Mr. Ken Calhoun, the President of TradeMastery.com, a leading education firm. Our presentation is for educational purposes only, and all the symbols and trading ideas that we discuss here are for demonstrational purposes. They are not recommendations. Our presentation is not an offer or a solicitation of any kind in any jurisdiction where any TradeStation affiliate is not authorized to do business. Active trading is not suitable for everyone, and there is a high degree of risk in option trading as well. They may not make it suitable for all traders. Please take a look at the disclosure information that I've posted into the chat panel in the 2 PDFs that you might find there that will describe some of the problems that traders can run into with various vehicles. Now, also in the chat panel is the upcoming webcast schedule here at TradeStation. And please take a look at that. We've got some exciting things coming up. Nothing's more exciting than today's presentation, however, and I want to turn things over to Ken Calhoun, the President of TradeMastery.com, right now.
Hey, thanks, Don, so much. I wanted to say thanks for helping with the technical issue. It's always something, I guess. Hey, can you see the presentation coming through okay on the platform? Does it all look good? Do you see the Meet Ken Calhoun screen right now? Okay, thanks, traders. Hey, good to see all of you here today. All right, well, I'm a UCLA graduate, former corporate quality engineer and statistician for the Ford Motor Company. I founded Day Trading University back in the late 90s. Now that's come under our umbrella company of Trade Mastery as we continue to expand our network of over 71 educational sites serving tens of thousands of traders. And I have proof I really trade. Great to see all of you here. You may have seen me in CBS Market Watch, the now sadly defunct Active Trader magazine. I'm a monthly columnist in stocks and commodities. I'm featured in TheStreet.com, and I'm a regular Money Show author. I just got back from Vegas last week, so it's great to see all of you here today. We're going to take a look. This is not a PowerPoint presentation. This is about it for the PowerPoints. We're going to jump right into the TradeStation charts. Really pleased to be here with all of you today. For trading gaps and breakouts, gaps are my favorite charts, and we're going to look at how to find the strongest gap entry patterns for both intraday and swing trading. If y'all would type in right now, are you a day trader, a swing trader, or both? Just type in the word day, swing, or both, and that'll let me know how to adjust the presentation on the fly based on the needs of the audience. Also known in my corporate training days as audience analysis. A lot of both and swings. Okay, good. Thanks, Paula. I can't read all the names. There's so many of y'all. Thanks. Swing and both. Wow, it's great to see such a big turnout. One of the biggest challenges, I've worked with tens of thousands of traders since 1999, and one of the biggest challenges people have is avoiding false breakouts. And so we're going to look at how to set safety buffers, regions within which you don't buy right above the obvious resistance to get in on a good breakout. Also, how to use TradeStation charts to find the strongest price action, gap, and cut breakout patterns, and how to set entries, exits, and more. So with that, let's jump into it. I don't know if anyone else is trading Best Buy today, but it was a great buy as it skyrocketed on up to new highs. This illustrates one of my favorite patterns, which is a gap continuation. And if you look at how strong this guy moved out of the gate, you can see a good strong breakout all the way starting from 9, 10 o'clock all the way through the rest of the session. One of the things that traders get problems with is trading gaps the wrong way. They trade gaps too soon, prematurely, or they'll trade too late. Now, I've done as much as 4.1 million in actual real money trades with brokerage P&L proof. I've done so. So I know how to trade, and one of the things I like to look for are gaps that move up after the opening 10 or 15 minutes. So one of the quick tips on a 15-minute chart is you might want to wait till after 9:45 before entering a gap continuation to make sure it is in fact going to take hold and run. Okay. And let me ask too, by the way, just a quick question. how many of you, number one, agree that it's important that educators prove with P&L proof they actually are real traders and not just chart talkers like a lot of the people? That's whenever I ask a money show, all the hands go up, but that's one of the things I thought would be important. I've proven I do real money trades, and I think that's important. Anybody can talk about charts. Actually trading the charts is a whole nother deal. So one of the things I think is important is to prove they actually really trade. All right, Ron. Ron's saying better yet, catch pre-market. Yeah, that's a good point. If you see a pre-market gap, and then I look for a small bullish cup, you may have seen my articles in Stocks and Commodities Magazine or Equities or Active Trader or in thestreet.com, my mentions and all the rest of it. One of the things you want to look for are continuous moves after the gap. And so what traders often do is they'll buy gaps that are extended or they'll buy gaps too soon. There's kind of a sweet spot. So we're going to look at gap patterns today and more. I think it's a good idea to see where things are headed and also where the best breakout patterns are. So that's what we're going to focus on in today's presentation. Continuous moves up. So for example, I don't know if anyone else is trading Snap. I was trading this a few weeks ago looking for breakout continuations. You can see the run up from earlier in the session. All the way from the opening, 9:30, 10, ran up all the way today in our market. We had a gap down and it closed the gap. Now this is a good pattern that I want you to learn how to trade. It's easier to see on this close-up chart. Do you see how this is an advanced pattern that people usually don't know about? If you have a gap down that not only fills the gap, but like a bullish engulfing, I've worked with my colleague Steve Nissen for nearly 20 years now, and it's good to look for candle reversal patterns. I use the same thought process for momentum play. So if something traverses or completely eclipses the previous closing trading range, the last 15 to 30 minutes, like Snap did today, and takes out new highs, especially if you have one of these tall green candles, that's often good for a continuous breakout. And you can see Snap ran today all the way from 2020 up to 2130, right? And that was a good breakout in today's markets. Closed off right over 21.5. So really good explosive breakout. So this is kind of the equivalent of a bullish engulfing and a downtrend. It eclipses the previous day's closing trading range, takes out new highs on a large green candle, and then continues to skyrocket on up to new highs. So those type of charts are patterns that traders typically aren't aware of. And if somebody's been trading since the 90s, I think it really helps to know the difference between what you're looking for. One of the things I like about the TradeStation charts is how clear they are, and it's really easy to see breakouts in progress, whether you're a day or a swing trader. So one of the key objectives, the point that I want you to get today, is what kind of charts are worth trading in the first place, and also how to trade based off pure professional price action. Not just, I don't use what my colleague Tony Turner would call chart spaghetti, a lot of derivative technicals like MACD and RSI and stochastic and Elliott waves and all that crap. All I trade is pure price action. I'm a professional trader. What I do is I buy high and I sell higher. That's what I do for a living. So if you see a very common technical pattern like a bullish cup, you'll often find a false breakout here. Now this one didn't. It just kept skyrocketing on up today, which is always nice. But the previous high, this bearish upper shadow here, was right under 21. And whole numbers often provide resistance. So another quick tip is never buy nines. So never buy, say, 20.9. Though it would have worked out fine today. For the most part, I don't buy nines. Actually, I never buy anything with a 9 in it. So I will not buy this at, say, 21.9 come tomorrow. I would wait for it to break over the 22 instead. So don't sell into whole numbers, but avoid buying right underneath whole numbers, because often things will stall and drop at the whole number. Like back here. See how it stalled right under the 21 whole number? That's what I'm talking about. So the same thing you can expect up at right under 22. You're likely to see a price action reversal. So never buy right under whole numbers. These are all things that I teach. You know, if my life depended on it, these are the type of strategies that you want to trade. Now, one of the rules that I often use is a 10% rule on gaps. Here's a good example of a gap reversal today. And my general rule of thumb is use a 10% threshold. If it's gapped over 10%, it's likely to fade back down, or it's and a 50-50 where there continues up. So you don't want to buy the opening candle of a gap up where the gap in price action is over 10%. So for example, this thing closed off yesterday at around 40.5, just under 41. It gapped all the way up to 56. Stop the madness. There's got to be a better way. And sure enough, this puppy dropped right out of the gate, bounced off the 52 like a basketball, twang, and bounced up to the midpoint, a mean reversion pivot. Anyway, the point is, don't buy things that gap up over 10% unless they continue after the first 15-minute candle. That can save you a lot in trades. I've done thousands of real money trades. I know how to trade gaps. I'm a professional. One of the things you want to look for is that. So for example, Best Buy did gap over 10%. It's a $50 stock, 10%. I used to be a corporate statistician for the Ford Motor Company. UCLA grad, dual degreed. I've got the numbers and the chops how to trade them. You want to look for patterns that are repeatable for continuous uptrends. So here, 51, 10% would be $5.10. So you wouldn't want to buy between 51 or above 56 unless the first or second candle takes out new highs. And in that case, you're good to go. Okay. And that tip alone is a rider downer. That's something that's worth paying attention to. By the way, I wanted to ask a quick question, and it's good for the folks at TradeStation who are professional and helpful and kind to know as well. And that is, how many of you think it's important that educators use like actual real charts from today versus cherry-picked PowerPoint slides from back when the dinosaurs roamed the freaking earth? Anybody have a weigh in on that? If you think it's important to use today's charts with actual real breakout examples from today versus old stale PowerPoints, sound off, say aye. Do you agree with me or disagree with me on this? Do you think it's better to have real-time charts from today's markets? Just a quick tip there for people who work with educators that that's everybody in capital yeses. Transparency with real charts. Yeah, Terry, Leo, Paul, Henderson, Mary, Glenn, Lisa, John, Rick, Assam, definitely. Thanks. A good point from Rick. Prefer both PowerPoint. The only PowerPoints I do are, you know, a quick bullet point of what the heck we're going to talk about and then illustrate it with. So you got a talking points, but then illustrate it with live charts. So thanks. Shows authenticity. Thanks, Simon. I appreciate that. There's a great book called Leadership Jazz by Max Dupree that one of my colleagues at Ford recommended, and it's all about authenticity, which is unfortunately all too lacking in the trading education industry. So authenticity, people know how to trade with real money examples of actual trades they did, kind of something you kind of sort of might want to pay attention to. Here's another one that's not for new traders, not for the faint of heart, but for experienced traders. PBYI, Puma Biotech, has been a real skyrocket. We covered this in my live room earlier during its meteoric run up here, and you can see the gap continued to run. It had been a $33 stock. Now it's a $77 stock. Welcome to the wide world of biotechs. Not for newer traders, not for inexperienced traders, but the profit potential is absolutely there when you look at the volatility in these guys, right? You always want to look at charts like you look at people. When I decide who to work with or who to not work with anymore, I look at things like authenticity, professionalism, helpfulness. Are they people who I would want to invite to dinner with my family? And the same thing with charts. You want to look for charts to see if they are charts that are sensible and are likely to continue after you get into them. And one of the biggest, I won't call it a secret to my success, but one of the key factors for successful trading is avoid choppy zones and trade only during breakouts in strongly trending instruments that actually make sense to trade, that have a consistent, repeated pattern of new highs day after day. Like I've been recommending NVIDIA, or I should say training people on how to trade breakouts in NVIDIA all last year from 38 all the way up to over 100, right? Or Disney a few years ago. I'm a Disney shareholder. I love all things Disney. But unlike the Magic Kingdom, the chart is full of bad charts. Are the stock market's full of bad things, not all rosy, happy things. So as a trader, you want to professionally look for patterns that make sense. Now here's one. I covered a money show the last 15 years called an acceleration ramp. And basically, just look for a steady uptrend like back here that leads to a sharper angle, 45-degree angle breakout that runs for at least 2 or 3 days in a row. And Square is a good example of that. Oh, thanks, Lee. I appreciate all the kind words, guys. I appreciate it. Anyway, so this is the pattern. Now, again, there's no magic indicator. I have Wall Street clients, my institutional clients, those guys laugh when people talk about special proprietary black box indicators and that kind of stuff. Professional traders use price, volume, and a very healthy dose of risk and money management. A quick tip, the math is a lot more important than the chart patterns, and I published that for years. The math behind the charts is a lot more important than the chart pattern itself, because this is history. It's, you know, unless we can jump in a TARDIS for the fellow Doctor Who fans, or some kind of time machine, a DeLorean, and go back in time and back to the future, you and I can't go back here and buy here. So we don't know necessarily it's going to keep running, but we do have a good, healthy optimism that something with this much sustained strength is likely to take out new highs. Don't be that trader. Here's a hammer, right? It's a hammer in a pullback. I just saw that. It's hammer time. Ba 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 da, swang. But still not so fast, Sparky, because this thing may well stall out right here. Professional traders, if I bought the pivot, I'm going to be selling to you right here. Newbie traders might be overly optimistic and get their panties in a bunch and try and jump into it too early. Stop the madness. That's not how you trade. What you do is you wait for new highs, and above the breakout trigger, a safety buffer should be a minimum of 30 to 50 cents. Now, a good rule of thumb for swing trades is add 50 cents to a whole number. For example, here's 21 breakout. If you bought 21.50, you'd be a little nervous on the first pullback, but then breathe a sigh of relief as it continued to skyrocket on up. 50 cents above whole numbers is a good general rule for a swing trading entry. You do not want to buy a new high of day breakout, because often that'll do a fake out. And you know, we know that that's frustrating. So if you've ever had the problem of concealing your trading losses from your spouse, and you know who you are, I always get nervous laughter when I do the public speaking or my seminars in Las Vegas, Dallas, California, New York, wherever I'm at in the world. Where in the world is Kate Calhoun? If you conceal trading losses from your spouse, and you don't have to fess up, because that's between you and your broker, but if you're that kind of trader, you may want to trade lighter share size and do what I call pilot trades. You know, something I've been teaching for so many years is, instead of just trade wide, not deep. One of my YouTube videos, I cover that. You want to trade, say, 6 or 8 or 10 instruments, not just 2 or 3 with the magic chart pattern on 500 or 1,000 shares. These are things that are lesson learned from thousands of real money trades over the last 20 years. Well, 17 years, almost 18 years now. And one of the things that I learned is, it's much smarter. You don't get as committed to a position when it's only one of a handful of 8 or 10 trades you're in. So it makes a lot more sense professionally, at least what I do, is I may, instead of 2 or 3 trades of 500 shares each, I may do 8 or 10 trades of 50 or 100 shares each. So that way I'm spreading my risk out, and I don't really care if any half of the trades don't work out, because it's the ones that do work out I want to scale into or position size into. Now, no good professional talk of trading would be complete without risk management. I always use a loss of 2 days support as a exit signal for a swing trade, and no more than 20 to 40 cents, and usually break even to a dime or 20 cents is what I shoot for day trades. So if you're long in a swing trade, a loss of 2 days support would be around 26.70 or so. So if the price gets down here, the trade is no longer valid because it broke the uptrend. If you have a 2-day, let's say you bought yesterday, you bought today, and you're happy in this chart, Boston Scientific, and it's scientifically taking out new highs. So we're a little excited, except for the fact we have a bearish engulfing there. But other than that, use a loss of 2 days support, say somewhere down here would be the maximum stop loss. You do not use a multi-day large stop, because it all adds up. You know, good trades are usually right from the start. Now here's one that's tempting, but it's not as good as some of the others that you might want to consider. Coca-Cola, KO the ticker. One of my rules, like 10% for gaps, I also find 10% a remarkably handy thumbnail value for a volatility screen, meaning at the high or the low of a, say, 2-week chart is less than 10% of the price, then it's usually not a good risk-reward ratio. So although this looks on first blush, you know, a good breakout, and it is, if you're a long-term trader, then fine. But if you're a swing trader, you know, from 2 days to 5 days or up to a couple of weeks maximum, you know, you've got to, the best charts are ones that have at least a 10%, which mean a $4 in this chart range. That's one of the things that took me many years to learn too. I always got excited about, you know, the force is strong with this one. Score 1 for Hufflepuff. Yay, it's up, it's running. But the point is, it doesn't have enough volatility, so I'm not going to make a lot of money trading this guy. So I'm going to pass on this reluctantly, even though it's a nice gap continuation momentum runner. The low is 43.60, the high is 45.40, so it's only about 2 points of range. That's only a 5% range on a $40 stock, so the math doesn't make sense. That's one of those aha moments. You have my word. It's very important. If you're friends and family, and hopefully you guys will become friends and colleagues over the years to come, one of the things that you'll find is that this column over here is more important. I wish I'd known this. You have my word. I've done millions of dollars worth of trades with proof from my brokerage accounts. Anyway, the point is this column is a lot more important than anything you see over here. This column of how many points of range is much more important than the basic simple pattern, because this is a nice uptrend, but I'm in it to make money. So let's say I buy 45.70 or so. That's a good 30 cent, minimum 30 cents above a high used for false breakout filters. So if I buy 45.70, best case this puppy's going to do is usually half of this range. And if I get really lucky, it might do the whole range. And if that's only 2 points, it's not worth my time. I'm not going to buy 45.70 and be all thrilled if I sell 47.70. That's only 2 points on a $40 stock. The numbers are upside down. Similarly, you don't want to trade those cheap, thinly traded penny stocks or pump and dump, low float, BS $3 stocks that some of these newbie kids are out there peddling, because you have to trade thousands of shares on the front end just to make the math of those work out. And that's a fatal flaw that, of course, they don't mention. You want your upfront risk to be as minimal as possible and your profit potential to be as large as possible. And if I were to draw a grid, which I'm not going to, but if there was a grid and you looked at trading range and upfront share size needed to make money with it, you'll see there's a sweet spot, right? And those are going to be charts, I don't know, like Snap, 1850 to 21 looks okay. Best Buy's a rock star, 51 to 62. We've got others to look at as well. So if you do trade charts that have good breakouts, make sure that you're also visually checking over here to see half the price projected best case target would be kind of like a Fibonacci 50% price extension range on the upside. Before eyes glaze over, just cut the chart in half and stack that on top, and that's about the best case for a target. So this thing traded 51 to just over 61, so that's a 10-point trading range. If I buy Boston, say tomorrow at say 62.5, if it breaks over that, let's round up again, half point above the whole number. So that's not a trading recommendation, but what I'll be using, 62.50. If I buy that, the best exit target would be how many points? If the total range here is 10 points, and we know that I used to teach MBA courses for private universities, as well as be a corporate training consultant for companies like Ford, Rockwell, McDonnell Douglas, Sheraton International. I've got a lot of blue-blooded, corporate training background before getting into this trading industry, and I kind of miss the executive steering committee meetings, but I don't miss the company politics. And so, but the point is, you got a 10-point range here. What would be the best case exit target on this? So a lot of traders screw this up. They say, well, it ran 10 points, so maybe I'll get another 10 points out of it. No, that's not going to be you. You're not going to do that. It's going to be 5 points, right? Half of the 10. You cut that in two and use that as your price projected exit target. So if I buy, say, 62.50, that yields a best case price target of 67.50. And I'm thrilled if I can buy 62.50, maybe get a fill at 62.70, sell up in the high 60s for a 5-point win. That's fine for a $50, $60 stock. Okay, so that's another rider downer. It's used 50% of this range. That presupposes that you have a trading range that's worth engaging with. So things like Coca-Cola, or I always pick on AT&T. I've picked on AT&T for 20 years as an example of a perfectly horrible chart not to trade. It's only got and it still doesn't disappoint. I haven't pulled up AT&T in weeks, and it's still a horrible chart. 37.50 to 38.70. It's got a 1-point trading range. If you're trading this, what were you thinking? I mean, how are you going to make money with that chart? So kind of like people. There's a handful of people you want to work with that are authentic and honest and hardworking, and other people that are difficult that you don't want to work with. And similarly with your charts, you want to trade charts that have good, strong professional breakouts that are likely to continue after you get in. This would be another good example of a chart not to trade. TSE, Tower Semi. Semiconductors have been strong, but not this one. I don't know if Taiwan's doing anything lately. It's a little better, but still not good enough either. Anyway, back to it. TSEM. It's in an uptrend, yes, but it's a choppy uptrend. The closer you can get as a professional trader to a clean 45-degree angle straight line, like a piece of yarn or dental floss tied tightly in a breakout pattern, the easier you're going to have it as a trader. You know, the punchline is there's all kinds of new highs being taken out. The problem is most of them aren't worth trading, and you have to know the difference in the patterns. And I'm giving you some insight in terms of the types of charts to look for. So for example, minor gap continuations like today in the spiders. This is our S&P. The spiders, our tradable ETF. Nice gap continuation. We have an inverse head and shoulder down here. That doesn't really concern me. What I care about is the right side of the chart. What's going to happen tomorrow or the next day? I like the fact that we're at a gap continuation. And this is who can name this pattern? Other than a gap continuation, what would this be if I were to mark it out? I'm not going to fool around with the price action lines in this guy, but it is a triple top. True, it is. It is that. Good job, Terry. What else is this? Well, thanks, Henderson, saying also true. This is also, if I were to connect the dots, well, this is one of my favorite patterns because it tells you the story of buyers winning the battle. Slowly, it's an ascending triangle, right? It's an ascending triangle. So if you're to connect the dots here, it'd make a line here and connect the triple top that Terry mentioned, that would be the top of the triangle. It's an ascending triangle. I still will not buy this right over. I don't buy this anything. I don't trade this anyway because it's $200 a share. Where am I going to trade that when I can trade things like this for a fraction of the price? But if I were to trade this, it wouldn't be at 242. It would be a minimum 242.50, at least 50 cents, because I expect the fake out right here. I expect a false breakout right above resistance 100% of the time. And the market seldom disappoints. Like here, poked its head up just enough to get in the newbie traders and then collapse back down to sell here by the end of the session for an intraday for the spiders. So always anticipate that the market's going to try and take your money, and always figure out a protective counter plan or countermeasures to get you in on the right charts and out of the ones that don't make sense. How about gaps that are continuing but have since kind of faded? Kind of like movie stars or TV stars from decades ago who are fading in popularity. They were hot back in the day, but now not quite so much. Well, I like the fact that Lumber Liquidators has gapped up, and this has been hot in my trading room for the last several weeks. LL's been good when it runs, but not this last week. It's been just kind of sideways. So you put it on the watch list. One of you mentioned too about Coca-Cola. Ron was saying didn't enter Co, but watching. Right. Put these on the radar. But what I like about this one that's so much better than Coca-Cola is what? One thing that I really hope that you get out of this, and it's really important. It took me many, many years, the price of many stop losses and the lessons learned and the jubilance of many wins to get this right, is this column is so vitally, critically more important than over here, this point range. And that goes to the math. You know, that's one of the things most of the educators don't even really trade. So those guys can't teach you risk management other than abstract BS. The truth of the matter is it's a lot more about the math and the money involved in the pattern than the actual pattern itself. So the math, you know, on your TradeStation charts, always make sure you're looking. So does this meet my 10% rule? Times 2, right? 25 to 30, that's a 5-point range. Street talk, we call a point as a stick. You say a 5-stick range, right? Ask any of my Wall Street guys. Like always, back when I used to do live seminars at the MGM Grand in Las Vegas or at the Sheraton Anaheim in California, or a Speak for Money show at Marriott in Times Square, which is always exciting. I always use this, and they always talk about how many sticks is that. So a stick is a point. So anyway, it's got a little Wall Street education there. So professional traders call point sticks. So we got a 5-stick range, and it's 25 to 30. It's got 5 sticks of range. So that's 20% of a $20 stock. So that's well over the 10% minimum threshold. Whereas if you compare and contrast with Coca-Cola, that's a rock star breakout chart. That's a beautiful chart, but it's kind of like, it's a beautiful woman, but she's got, I don't know, personal problems. Or it's a beautiful job offer, but the boss would be a real a-hole. So how many of you have ever worked for a boss or worked with coworkers who are real jerks? Anybody, show of hands? I've not worked for another man since the year 1992, and thank goodness, because I like to make my own money. Because when it comes to working with other people, I say stop the madness. There's got to be a better way. If you've ever worked for a boss who's a real moron, or worked with other coworkers who are real difficult people, you know it's blissfully better to work with money and charts than with people. At least that's my preference. That's why I like working with traders and folks in the trading industry, but that's kind of it. So anyway, the point is, this is a rock star breakout. But the fatal flaw is kind of like, he was a great job candidate, and I almost hired him, but he was absent all the time. Or she was a great job candidate, except she was late half the time and had excuses up the yin-yang. So anyway, the point range is only 43 to 45, so it's only got 2 points of range. I'd love this chart if it had, say, 43 to 50 as a range, or minimum 4 points. So 43 to 47 is the range I would trade. And yes, it does count. It is so important that you guys learn this. You have my word. It's the honest truth of how to actually trade, the right way and the right kind of chart. So anyways, we get back into it. You see where they had. Let's look at some new charts too, because we got some to work with. Groupon is good, 88 to 93. It doesn't yet have a 10% range. Some that are getting close. Again, I don't like trading things in general over 50, maybe 70 bucks a share. So this one's a little pricey for me, but it does illustrate a good cup pattern breakout with a gap, which is why I brought it to your attention. We've got a cup here, and oftentimes on the right side of a cup, kind of like a poker tell. I play tournament poker in Vegas. I won my first tournament 6 years ago. It's great to be the last guy at the table with all the chips. They all look at you like, what was your secret? It's like, well, I was very selective, and I was aggressive when I was supposed to be aggressive, and I was conservative when I was supposed to be conservative. As a trader, you want to do that too. So you're trying to take chips out of the Wall Street pot, and you're not trying to gamble. You're trying to make money. So what's a poker tell? Kind of like pupils dilate, or the what do you call the blood vessel in the neck moves, or whatever. You could tell when somebody's bluffing or whatever. In a chart, you can tell when institutional buyers are coming in with large volume with a minor gap. And that's, even though it's not above the previous resistance, so we don't trade it in this region, that is enough to put it on my radar, right? Because we had a minor gap that had a big green candle. So that says buyers were in the house. I still would not buy it until it broke over there plus 50 cents. So 90.5 would be the long trigger, and that would have worked out like a charm. But that's a quick advanced tip that you haven't heard anywhere else, I'm sure, is look for minor gaps inside prior ranges combined with a large green signal candle, kind of like a large green candle at the right side of a cup. That's one of the patterns I've taught traders for over a decade now. And you look for these minor gaps that continue. This should put it on the radar, just this, a large green candle after a minor gap. That's institutional buyers are all excited. We're still skeptical, right? We still don't want to buy because it's under the high, but that does put it on the radar. And that way, once it does have the signal day on a gap continuation and it takes out new highs above the 15-day first candle, that tells you you're good to go for a breakout. Okay, and then here we have an inverse head and shoulder. Not quite. I'll just call this a cup pattern with the previous high there, and it took out that high. So does that make the sense? The kind of sense that you need as a trader? It's a very intelligent, very specific, very well defined, very easy to understand. Maybe not easy to understand right out the gate, but eventually you get to a point as a trader where you realize it's all about the money. It always was. It's not about magic chart patterns. The chart patterns just qualify it from a visual scanning standpoint to be worthy of consideration. So here you can see this guy ran from 29 to 33. Does that meet my 10% rule? Yes, it does. So it is worth trading. And again, they're not a buy recommendation. If we just add 50 cents, again, you can't trade like a spreadsheet. There's more to it than that. If the S&P's down and our SPUs, our futures are down that morning, then I may take a pass on it or take a flyer because the market's down. But if we have an up market and this guy's taking out new highs, let's say it does a little minor gap tomorrow or Tuesday. Remember, the markets are closed Monday in observance of Memorial Day. I'd wait till, say, 33.5 because I expect it's going to try and pull a fast one on me, and the market makers and specs are going to step on the ask and drive it back down at 33.10. That's where the newbies would trade where I'm pointing. Experienced traders say, not so fast. I want to wait until it's built a head of steam and it's got good, strong momentum, kind of the wind under the wings, so 33.50 would be the first earliest long. Another quick tip, I've trained so many thousands of traders. One of the things that I will tell you is good trades are usually good from the start, but the punchline is, and this is really important, and it took me a lot of years of real money trades to figure this one out, is good trades feel like you're late to enter but early to exit. In bad traders, it's the exact opposite. It took me almost 7 years to learn that the hard way. So for what it's worth, learn from my mistakes. I've made every mistake in the book and then some. And I'm so grateful to all of you for finding value in my teaching and the world's traders. I appreciate everybody learning with me. Well, one of the things that I realize is that good trades, product method of teaching, and all my corporate training consultants and clients and people I trained, over 30,000 people around the world, appreciate that. Of course, they also say that's why Socrates was poisoned, because it drives people nuts with questions, but it gets you to think. Adult Learning Theory 101. I used to do Train the Trainer for Ford Motor, and one of the things we always do is make sure that adults learn best by doing, not just nodding your head like you're watching a rerun of a TV show or something. And all the TV shows are coming to an end right now, so that's kind of sad. We're going into the summer, so good time to get out of the house, but not for trading. And trading, you want to be here in front of your charts. So my question to you is, does this meet my minimum volatility threshold, CYOU? Is that at least 10% on a 10-day or 12-day or 15-day chart? Pay attention to this line. This is going to make or break you as a trader. Not so much, and it's a great trend, but it's starting to fade back, so we don't want to trade it until it takes out new highs way up here. But yes, it's 32 to 40. Right, and thanks, Lee. Yeah. A question from John: how do I create a daily breakout stock watch list that I use for daily trading? I will usually look at news plays on some of the popular media sites. There's a variety of different scanning tools that you can use both within TradeStation and elsewhere, but the percent leaderboards, another place to look at is 52-week highs, right? Anything about TradeStation, it even has this easy language. Didn't have anything, I programmed this years ago. I forgot what the Boolean operators is on this. Anyway, I programmed a scanner many years ago. Let's see what the settings are. So last is greater than a 52-week high. You can write this down and program this yourself. It's a nifty little scanner you can use in TradeStation, and I developed it myself because it's what I use. Last is over a 52-week high, and the one-day average volume is at least 1 million shares a day, and that's important. For swing trades, I like instruments that trade a minimum 1 million shares per day. For day trading, I like at least 15,000 shares per minute. Okay, so. And it looks like that's just the NASDAQ scan. So yeah, so I don't have the NYSE in here. If I did, I'm sure I'd see quite a few. Anyway, the point is, you can develop your own custom scans like that. And one of the biggest things that I found to achieve success, I've done millions in sales in my company, and I've reached tens of thousands of traders, is always be on the lookout for testing new ideas. Testing. Always be a fan of testing. I don't back test anything because that was then, this is now. I forward test. You know, I'm a real money trader, so I like to see, is my latest, greatest idea going to work in tomorrow's markets? Like, don't buy right under a whole number because that ends badly, right? Here's whole number resistance in this one. See, 40 whole number. It ran right up to the 40 and then did a mean reversion pullback. You may have seen my article in Stocks and Commodities on intraday. I did 2 articles, one on day and one on swing trading mean reversions, or 50%, where it'll run up, it'll pull back down to half and then resume its trend. Anyway, this thing ran into hard resistance at the whole number. So that's why we don't buy 9s. We don't buy, say, 39.7 for a swing trade because we know it's going to stall out at the 40 and end badly. So as a good trader, you need to know these price action rules. It's a completely different and much more intelligent, well thought out, statistically valid. You know, I'm a certified quality engineer. I used to be nationally known in the total quality management arena and was nationally published and such, and I was invited to speak all over the country and for events, and I was a Baldrige Quality Award examiner, and I worked for Ford Motor Company in quality, and McDonnell Douglas, which built the C-17 aircraft, and I was the TQM coordinator at Rockwell International for the GPS satellite program. I've got a very strong quantitative background. I'm the guy who I endeavor very hard not, though, to make your eyes glaze over with talk of process capability metrics and Taguchi loss functions and design experiments and all the rest of it. Instead, I like to teach the world's traders how to trade based on good volatile breakout patterns that make sense. And so we look for these kind of price action repeatable patterns. So we know from experience, never buy right under a whole number, and especially under a decade value, because it's likely to stall and drop. You know, if you do look for charts, make sure that you've got ones that at least have a 10% range here. And again, there is no substitute for your hard thinking. If you want to make it in this world, if you want to be successful, I'm a wildly successful entrepreneur. I work with whom I choose to work with and discontinue working with people who are difficult. One of the things that that luxury affords me is I'm very careful about the patterns that work. And just as with people that I choose to work with or not, when I look for patterns to work with, I look for patterns that have the best repeatability and the best consistency. So that 10% guideline, again, it's not written in stone. Test and experiment for yourself. but at least 8 to 10% should be the minimum point range of an instrument you're considering trading. Now, there's a probably point of increased risk if you don't want to trade something like a biotech that has a 50% range, or one of those stupid never trade penny stocks or stocks under $10. Those are for losers. Stocks under $10 are usually horrible. Only morons and amateurs trade stuff under $10. And if you don't have money to trade, then don't trade. Put it in an IRA and, I don't know, get a job or something. But, traders, it's not for cheap people that don't have much money to trade. I got a question on one of my YouTube videos. They got thousands of views, and somebody asked, I'm a college student. How do I start day trading with a small account? Just face palm, right? Epic fail. Put the money in the bank. Go meet some girls. Do well in your studies. Don't try and day trade with a penny stocks or any crap like that, right? You want to trade instruments with sustainable volatility. There's a lot of hoo-ha out there from these kids under 40 lately trying to mislead the trading industry to trade low float, cheap $3 or $4 stocks. That does not work. Show me the tax returns of anybody for whom that works. And I'll hear, what is that I hear? If I hear for tax returns of any educator who trades penny stocks or cheap stocks and claims to make a lot of money, what will you hear? Oh, it's crickets chirping. Gotta have some fun with this. So just say no. Stop the madness to cheap, crappy stocks. Trade instruments with sustainable trends that make sense. If you do trade stuff that's cheap, it should have a range like this INO one. This is one rare under $10 stock I was calling short for my members because it had a big range, 7 to 9.5. So that's a big range. It's still a dangerous as heck chart. It's not, and it's most likely to just go sideways. It's not likely to make a big bounce from here. It's 50% exhausted. It's at the midpoint, so like a doji, it's likely to just go sideways. So, that's not the right kind of chart to trade. The right kind of charts to trade are instruments that have sustainable uptrends. Like today's snap, right? Snap, crackle, pop, baby, and that one's in play, right? That was a good chart for anybody who's trading that one, or Best Buy. Those are my two favorite charts today, was Snap and BBY, right? And for those of you just logging in, remember this pattern, and that is where because this is an advanced one nobody teaches. Until all my competitors who are watching this copy me like they always do. They copy my university idea. They copy my wide range candle at the right side of cut pattern ideas. I'm the most widely ripped off guy in the trading industry. I don't care. I still eat steak and lobster and stay at Bellagio. So anyway, it is what it is. Look for reversions or price that the gaps down and not only fills the gap. Those, by the way, are really good for shorts if it fails to break above the previous day's high. That's my favorite pivot play, is a short down that way. But if it gets some new buyers in, and these are rare, by the way, you don't see these often, but it's a very predictable pattern. If it traverses or eclipses the last 30 minutes or so of the previous day's session, it will often continue on up, especially if you have a large green candle here, right? So if you bought 20.7 or 20.8, it ran all the way up to over the whole number, which is good. Usually I use whole numbers as exit targets, but in this case, it ran all the way up to 21.20, 21.30 before doing its sideways dance. But that's a kind of a equivalent of a bullish engulfing on a daily candlestick chart. It's the equivalent thinking is that if it's strong enough to overcome all this initial skepticism, get so many buyers that they blew right through the previous day's closing trading range and continue on up to new highs today, especially on a green candle with high volume, that usually leads to a nice breakout like we saw in Snap today. So that's another good example. Classic gap continuations like Best Buy are my bread and butter. What you want to do though is, wait until you see the first cut pattern. In this case, that didn't even occur till after 10. It took its sweet time. We were watching it all morning in my live trading room. We didn't take any shots at it until it broke over 58 because this is still in a trading range. So wait till a bullish cup, or if you see pre-market, a bullish cup, and then it continues up in trend in market. A bullish cup breakout usually makes for a good gap. And that's an important distinction, is where traders get in trouble is they buy the first sign of a gap up that runs a little bit, they get stopped out, and then it does its big mother of all runs without you. Really used to piss me off, right? Or pardon my French. It used to upset me a bit. If I get, how many of you have done this? I'm just curious. You were directionally right. Eventually, it did keep going up, but not before you got stopped out. Give me an I. How many people agree with me? Do you agree with me or disagree with me? It's going to be really frustrating. You were directionally correct, and it's to rub salt in the wound as though the trading gods had it in for you. It did keep running on up, but not till after you got stopped out on a shake on the first breakout. That's really frustrating, at least speaking from my own experience. So what you learn is When in doubt, stay out. When in doubt, stay clear. Wait until, again, good trades feel late to get in and early to exit. Now, this thing kept running all day, so good for it. I'm usually not patient enough. I get out by lunchtime. But anyway, it's still good for 1.5 points before lunch, right? So that's good. I used to trade all day long every day. And then I realized, another quick tip for those of you who are day traders, the worst day to trade is usually Monday. And the second worst, kind of 50-50, is Fridays. In our choppy markets we've had the last couple of months, these kind of exceptional gap breakout continuations or two-day high breakouts, usually best Tuesday, Wednesday, Thursday during the first hour of the market. And that's it, which is great from a time management standpoint, because you don't have to screw around sitting around in a chat room all day long every day with twiddling your thumbs waiting for something to move. That's not the right way to trade. You want to front load your success by identifying gappers as they occur, set up buy stop orders in your trading account, and then let the market come to you. That's another good quick tip for day and swing trades. Is what I will do is I use buy stop limit orders. So you set up a buy stop limit order in whatever you're trading, maybe 4 or 5 different instruments, 6 different instruments, and let the market fill you automatically so you're not chasing. Like back in the 90s, I'm one of the original .com day traders. I used to run Day Trading University. And one of the things that I found is it's very nerve-wracking to be on the edge of your seat, finger on the mouse button, because often you make wrong trades, or you may trade too many shares, or you miss a trade because you're off trading one stock but something else ran without you. Instead, set up a sequence of 5 to 8 buy stop limit orders before 9:30. So that way you can see where it's gapping. You say, well, I don't want to buy till 58.50 because I want to be cautious. So that's fine. You get the order fill at 58.50 and you let it go up as far as your nerve as you get in, and still don't really see any reversal signs. It'd still be okay for a swing long with this pattern. But I like to get out in the middle of the day. So just personally, that's my own personal preference. I heard a lot of yeses from Osam, Lee, Reynolds, Stephen, Leo, Rick, Lisa. Hey, Lisa, from Paul and Teresa. A question from Henderson, sure thing. Oh, I got a lot of questions. Okay, thanks. Let's see what we got here. Let me answer them. So let's see. Thanks for the questions. That's one thing I like. I've been training so many people over the last, since 1999. What's that? Almost 18 years. The quality of questions you folks ask is getting so much better now than it used to be. So that's good. Well, some saying, do I use level 3 data to focus on charts and 10%? No. I used to teach how to follow the axe on level 2. I was the original guy to teach that. Then I got copied. But no, I don't use a level 2 or a level 3 box. You'd only use a level 3 box if you're trading over 1,000 shares for scalping, usually on smaller size instruments. But then that's a riskier way to trade. I prefer simple, strong price action breakouts professionally. So I stopped using. My colleague, who's no longer with us, unfortunately, the late great Don Bright, also said in one of his columns that the need for level 2 was reduced. He was the world's top expert on direct access trading, and he and his brother Bright Trading out of Vegas, and he said that after decimalized trading and high frequency trading algos and dark pools, we use tape reading, right? So I use the tape. I don't use level 2 or level 3 box, even though I know that's the NASDAQ workstation. Level 3 is what the market makers use. We're not making markets. We're just trying to profit on breakouts, so we don't need that level of depth. Hey, thanks. Lyndon saying clap, clap. Thanks. I appreciate it. I'm with you there. The punchline is keep it simple is best, and test and use small share size and be conservative, right? That's all makes sense. It's not about getting some fancy proprietary black box indicator that magically does your thinking for you. Sorry to burst your bubble there, Sparky, but that doesn't work. Market makers and specialists laugh at people who use that. They don't use that kind of stuff. They use price and volume and their P&Ls. That's all the 3 things you need to trade successfully. Price action charts like what you see here, volume down here so you can see how committed or not the institutional guys are to their positions, and then you know what kind of share size to put on. It's another quick professional writer-downer tip. I'll get back to the questions too, but the larger the delta or the difference in institutional share size you see in the volume bars, the more share size I put on in a trade, because I vote with volume. Traders vote with volume. My institutional clients, as well as home retail traders, everybody out there, the more the volume is there, the better the trade is. So, with something that has a spectacular volume, instead of, say, a standard 1 or 2 or 300 share trade, I might do a 500 or 600 share trade because of all that exceptionally high volume and a gap continuation pattern. It's my favorite pattern, and a favorite volume breakout. That's the macro and the micro. The punchline is this is not tough to get once you learn the differences between patterns visually. It simplifies dramatically your rule, and the rules are very simple, right? I use 2-day low, maximum stop loss on this guy. So for example, what would be your drop dead? And I always, with so many of my students, I always tell the difference between successful and unsuccessful traders. I got lots of both when I see them in person at my money show appearances or my live seminars all over the world. How big are your stop losses on what share size or contract size or lot size, whatever they're trading? And to a man or to a woman, the smaller the share size, the smaller cost of stops they take, the better a trader they are. And that's one thing that I've adopted firmly in my own framework. So the smaller the stop loss, the better. Now, I would start, if for example, I got in long on a breakout at say 2150 or so today on a fill, I would get back out half the position at 21 and the other half I'd stop out on a loss of 20. Because the only reason that this trade made sense would be it broke out over 2150, and this is snap today, right? If it violates that and comes back down, I start to worry. If it loses the whole number, I start to go to cash in half the position. You scale in and out with two size increments. You don't all or nothing the trade. It might be 300 shares at 2160 and another 300 if it breaks over say 2360 or so. If it gets back under support, under a 2-day support line, in this case 20, that would be the proper place to go back to cash because the trade's completely no good if it loses 2-day support on a swing. Question from Reynolds, what would you recommend day trading option for small accounts? You should not be again, I'm not giving personal recommendations, but in general, my thinking is day trading is not for people with small accounts. That's why our illustrious SEC came up with the Reg T $25,000 rule to keep people with small accounts from losing all their money, right? Day trading is not for people with small accounts. No matter what the vendors out there, the new crop of BS vendors that have unfortunately sprung up from bad places this last 4 or 5 years are trying to mislead people into thinking they can day trade with a $3,000 or $4,000 or $5,000 account. If you only have a few $1,000s, again, not a recommendation, but my personal opinion is you're a swing trader. You're not a day trader if you only got a few Xander 25K. Okay. And good point from Lyndon about BBY and a short squeeze. Yeah, you're right. That's why the volume was so high, right? And yeah, Rick, most of the tips today are for swing trades. A question from Anderson, a question for you. You spoke about range in terms of volatility. Do I use the average true range to help decide? I used to use the ATR indicator, but the more experience you get as a trader, you can visually see about how big a day's trading range is. So for example, if I were to plot the ATR indicator on this chart, you would see it do what? Increase. If you were to plot the ADX indicator, you'd also see an increase. The better you get as a trader, the less you rely upon secondary technicals. Just like a statistician or chief statistician, you go to a manufacturing plant, you got millions of dollars of production going through a production line on first shift or swing shift or whatever. You eyeball the charts and you can see variation patterns, and you don't need, data mites or red and yellow lights to tell you something's in control or out of control. As a trader, you should be able to visually, and this just comes with practice over time. Again, this is a profession that takes a lot of years to learn. So during your formative years as a trader, say your first 10 or 15 years as a trader, and yes, it takes at least 10 or 15 years to trade, you should be trading paper or very light size. You should not be out there, gung-ho trading large size, blowing up your trading account, because then, we can't work with each other, right? It's better to be a student of the markets, paper trade until you get really good at it, and then go to small share trading. I know everybody's impatient. You want to be the next .com trading billionaire, and like some of these morons on YouTube videos, they're traveling all over the world. And yeah, where do you think that money came from? It's not from their trading, it's from selling stuff to traders. So anyway, you got to wise up. Like a line from one of my favorite movies, The Cotton Club with Richard Gere. It's a great movie about jazz era prohibition and Al Capone and all that back in the day. Anyway, you got to wise up as a trader and make sure you're trading strong charts with a very careful dose of risk management to make it work. There are no magic silver bullet indicators. It's a lot of roll up your sleeves and work your tail off, like I've done in 16-hour days since the 90s or 99. That's what it takes. And understand equally which charts like this one aren't worth trading because they're choppy. Yes, it's in an uptrend, but it's no good. I mean, unless you're a position trader for 8 months or something, then more power to you. But if you're a swing trader or a day trader, you want things that are likely to continue within the next 3 or 4 days. It's like, hey, while we're awake, right? So that's the kind of patterns you want to look for. Any of the last questions? I got just a few minutes left. Oh, thanks, Henderson, saying okay, makes sense. You are welcome. Remember that 10% rule, 10% minimum criteria. So Coca-Cola, great chart, but not good enough volatility, right? CYOU, great chart and great volatility. Now, I'm not saying it's going to keep going up. I wouldn't buy it till it breaks well over 41 because it's in a pullback region, and it may well drop down here to 36 and bounce. It may just chop and drop down here. So we leave these kind of charts alone. You don't try and catch the first wave of I never buy pullbacks and uptrends because although a lot of people talk about that, overall it generally doesn't work. You can find, say, bull flag breakouts, but what you don't want to do is try and say buy the first sign of a breakout because that's iffy and it's just as likely to keep chopping sideways or drop. What you want to do is get in at a price point that's likely to attract a whole lot of institutional volume, not speculators, right? You don't want those darn pesky day traders or those darn pesky retail swing traders. You don't want us buying. You want the hedge fund managers out there and the CMTs who are advising the professional trading community to issue a buy signal, and that ain't going to happen. That's, correct my English. I'm a UCLA grad, so I don't use words like ain't too often, but that's not going to happen in here, right? So wait for confirmation for a high, and then be a little more cautious and skeptical before you put on the trade, and then still use a tight stop, right? That's real money trading experience over a lot of years. Never underestimate the force or the power of a trend. And so the spiders and the S&P continues to skyrocket on up to new highs. We have an ascending triangle, but tomorrow may gap down and sell off with the mother of all sell-offs, right? That makes trading life exciting. I don't know about y'all, but I'd much rather work with charts and traders than people in big companies. So that's why I no longer do that, because I got the luxury of money on my side. So it's great. And you guys have been amazing too. I appreciate all the kind words and the smart questions. I hope that it helps give you a sensible price action, good, strong breakout filter approach to trading the right charts the right way in our current markets. Let me wrap up by just 2 quick slides. And nothing to sell. By the way, let me ask, I always ask a Money Show, how many of you agree that before you spend a nickel on any educator's courses or alert services or whatever, the free content they gave you, like I just gave you, and hopefully will be up on YouTube to reach thousands of traders over the years to come, should pay for itself and make winning trades for you before, kind of like going to Costco and getting a free sample. It should taste good and make money for you before you consider spending money on their stuff, right? That's one of the reasons I've been around for 20 years, because I teach people what I found works, and they do that. So I'm Ken Calhoun. Thanks so much for being here at TradeMastery.com, formerly DayTradingUniversity.com, but I have so many swing traders, I put both Swing Trading University and Day Trading University under the Trade Mastery umbrella. So will you be our next winning trader? I don't know, but I certainly appreciate y'all's taking time to be here, and I hope that that starts giving you a sense of clarity on the differences between the right kind of charts to trade and the volatility and trade management, the stops to use, the risk management, the types of breakout patterns, and more importantly, the volatility of charts that are worth trading is kind of a fine-tuning approach to help you the next time you're up to bat with the trade. So, and I thanks us. I mean, I've got lots of courses. I got 71 websites. I've been a busy bee the last 20 years. Tens of thousands of traders. And thanks so much, everybody, and you're welcome. I appreciate all the kind words. Thanks so much to the folks at TradeStation for having me. It's great to be in front of all the traders. I emailed my whole list at Trade Mastery too, so all of my traders, welcome aboard. I wanted to, on behalf of TradeStation and myself, say thank you for your time. I hope this helps you make bigger winning trades more often, a way of life. And until next time, I'm out of here. Thanks so much, and thanks, Don, for having me. Appreciate working with me, and thanks so much to the TradeStation team. See you guys on the other side. Take care, and best wishes for success in your active trades. Bye, all.